Smart was originally conceived as a bold urban mobility experiment. Small footprint vehicles, innovative design, and city-focused practicality defined its early identity. Backed initially by industrial ambition and significant capital support, Smart represented a vision of compact efficiency in crowded metropolitan environments. Yet as the global automotive industry approaches 2026, Smart finds itself confronting structural weaknesses that extend far beyond niche positioning. The brand is now navigating debt pressure, scale limitations, and strategic ambiguity that collectively threaten its long-term viability. The central issue facing Smart is scale versus cost. Building cars today requires enormous capital investment in safety engineering, regulatory compliance, software integration, and electrification. These costs are largely fixed. They do not shrink simply because vehicles are smaller or because they are aimed at narrow urban markets. Smart's historic volume levels were insufficient to absorb these costs effectively, and that led to persistent financial losses over many years. The shift toward electric vehicles has intensified this burden rather than relieved it. Electrification demands heavy upfront investment in battery supply chains, dedicated platforms, and digital systems. While Smart now focuses exclusively on electric offerings, that strategic clarity does not eliminate financial strain. In fact, it increases it. Electric vehicles remain capital-intensive and margin-sensitive. Price competition in the compact and entry premium segments is fierce, particularly from rapidly expanding Chinese manufacturers. Smart must compete in this environment without the benefit of massive global scale. Debt pressure operates at both direct and indirect levels. Even when the brand does not carry excessive standalone leverage, its operations rely on sustained capital support. Cash burn from product development, marketing relaunches, and international expansion accumulates over time. If returns fail to materialize quickly, internal tolerance for losses erodes. Brands that consume capital without clear profitability timelines eventually face difficult reassessments. Product repositioning has added complexity. Smart evolved from ultra-compact city cars to larger, crossover-oriented electric vehicles aimed at broader markets. This shift attempts to escape the limited margins of microcar segments. However, it also places Smart into direct competition with established electric brands that possess stronger recognition and distribution networks. Entering crowded segments without dominant differentiation increases risk. Brand identity now appears diluted. Originally synonymous with minimal urban mobility, Smart is attempting to redefine itself as a modern electric lifestyle brand. Such repositioning requires consistent messaging and flawless execution. Yet frequent strategic resets undermine consumer confidence. When buyers struggle to understand what a brand stands for, they hesitate. Hesitation depresses sales and deepens financial strain. Dealer and distribution challenges further complicate the outlook. In many markets, Smart operates through limited networks or shared retail environments. Low throughput reduces dealer profitability and weakens commitment. Electric vehicles require investment in charging infrastructure and training. Retailers may be reluctant to allocate resources without clear volume potential. A thin distribution network reduces convenience and visibility, reinforcing weak demand. Residual value risk is significant. Electric vehicles in competitive segments face rapid technological evolution. If Smart models depreciate quickly due to market skepticism or limited brand trust, leasing costs rise and financing subsidies increase. These subsidies represent real cash outflows that strain financial sustainability. Attractive monthly payments often conceal underlying margin compression. Operational execution risk remains high. Transitioning from small internal combustion vehicles to electric crossovers demands new supply chains, software capabilities, and manufacturing coordination. Any delays, quality issues, or cost overruns amplify financial vulnerability. Small brands have less room to absorb mistakes. Larger competitors can distribute setbacks across broader portfolios. Smart cannot. Macroeconomic conditions add another layer of volatility. Urban mobility demand fluctuates with economic confidence, fuel prices, and regulatory incentives. Electric vehicle adoption depends heavily on government policy support. If incentives decline or economic uncertainty rises, entry-level electric vehicle demand can weaken sharply. Smart exposure to such volatility increases strategic risk. The broader competitive landscape is unforgiving. Compact electric segments attract aggressive pricing strategies. New entrants, backed by strong capital reserves, may accept thin margins to gain share. Smart must either match those prices and sacrifice profitability, or maintain pricing and risk irrelevance. Neither path guarantees stability. The cumulative effect is a brand operating within a narrow margin of survival. Cash burn must be controlled without stalling innovation. Volume must grow without excessive incentives. Identity must be clarified without alienating legacy customers. These competing priorities create tension that is difficult to resolve under financial pressure. Please subscribe to our channel. We want to reach 1,000 subscribers this week. For consumers, Smart's evolving situation carries practical implications that extend beyond styling or environmental appeal. Purchasing a vehicle involves a long-term relationship with the manufacturer. That relationship depends on consistent support, stable resale value, and confidence that the brand will remain fully operational throughout ownership. When a brand operates under sustained financial pressure, these assurances weaken. Warranty coverage remains valid, but the ownership experience depends on execution. Brands managing tight budgets may tighten approval processes or reduce goodwill accommodations over time. These changes are gradual and rarely announced, yet they influence satisfaction significantly. Owners may encounter longer wait times or stricter interpretations when seeking repairs. Parts availability presents another concern. Low-volume brands often face limited economies of scale in component production. Unique electric vehicle components may have longer lead times. If suppliers prioritize higher volume clients, Smart owners could experience delays in repairs. Extended downtime undermines the convenience expected from urban mobility solutions. Software and digital support are increasingly central to electric vehicle value. Updates improve range management, charging efficiency, and user interface functionality. A brand balancing cost control with innovation may slow development cycles for existing models. Over time, vehicles can feel outdated compared to rapidly evolving competitors, affecting both satisfaction and resale value. Depreciation risk is significant in competitive electric segments. Market confidence influences residual values as much as engineering quality. If Smart struggles to maintain visibility or financial stability, used vehicle prices may decline more rapidly. Higher depreciation raises total ownership cost even if purchase incentives appear attractive. Dealer network stability also affects everyday experience. Limited retail presence can mean longer travel distances for service or fewer appointment options. As networks adjust to shifting volumes, some markets may experience consolidation. Reduced convenience erodes ownership confidence. Strategic uncertainty compounds these concerns. If Smart adjusts its product roadmap, delays launches, or repositions again, owners may feel disconnected from a stable ecosystem. Even without abrupt withdrawal, prolonged ambiguity weakens brand trust. None of this suggests that Smart vehicles lack innovation or appeal. Modern electric offerings provide contemporary design and urban practicality. The issue is durability of support and long-term financial commitment. Electric ownership requires confidence in charging infrastructure, software evolution, and parts supply for many years. That confidence depends on a financially secure manufacturer. From a forensic financial perspective, Smart represents elevated risk within a volatile and capital-intensive segment. Its survival depends on achieving sustainable scale and margin discipline in an environment that punishes weakness quickly. Consumers considering Smart should weigh environmental benefits and design appeal against long-term uncertainty. In a market defined by rapid technological change and aggressive competition, choosing a brand under sustained pressure carries consequences that extend far beyond the initial purchase decision. Please subscribe to our channel. We want to hit 1,000 subscribers this week.